Hello bookers, welcome to Let's Book, which is an episode of Let's Book Economy. Money, the lifeblood of any economy, flows through the veins of our financial system. The Fed acts as the central bank of the United States. It manages the nation's money supply. This means it influences how much money is circulating in the economy. The Fed controls the money supply through sophisticated methods. These methods involve influencing interest rates and interacting with commercial banks. By adjusting the money supply, the Fed aims to achieve specific economic goals. These goals include stable prices, full employment, and sustainable economic growth. The Fed's control over the money supply is a carefully calculated endeavor guided by economic data and analysis. The Fed's mission is a delicate balancing act. Too much inflation can be detrimental to the economy. On the other hand, too little economic growth can lead to stagnation and unemployment. The Fed must find the sweet spot, the delicate equilibrium that foster a healthy and vibrant economy. The Fed constantly monitors economic indicators and adjusts its policies accordingly. The Fed's decisions impact various aspects of our lives, from the interest rates we pay on loans to the overall health of the job market. Before the Federal Reserve, the United States lacked a centralized banking system. Imagine a time when each state had its own currency, a chaotic patchwork of financial systems. This decentralized system was prone to instability, leading to frequent financial panics. In the late 19th and early 20th centuries, the US economy experienced rapid growth and industrialization. However, this growth was accompanied by financial instability. Banks operated independently with little oversight or regulation. This lack of coordination often resulted in bank runs and economic turmoil. Business leaders, economists, and politicians recognized the importance of a stable financial system. The stage was set for the creation of the Federal Reserve. In today's interconnected world, the Federal Reserve's actions have implications that extend far beyond US borders. As the central bank of the world's largest economy, the Fed's monetary policy decisions can influence interest rates, exchange rates, and capital flows, affecting economic conditions in other countries. The Fed can coordinate with other central banks around the world, sharing information and collaborating on policies to promote global financial stability. This cooperation is essential for managing risk that can spread quickly across borders, such as those arising from global imbalances or financial crises. Fed also plays a role in providing liquidity to global financial markets, particularly during times of stress. For example, during the 2008 financial crisis, the Fed established swap lines with other central banks, providing them with US dollars to meet the needs of their domestic financial institutions. Interest rates represent the cost of borrowing money. Loans like mortgages or credit cards involve paying interest as rent for money. The Federal Reserve influences interest rates through monetary policy. Adjusting the federal funds rate affects the entire financial system. Lower rates stimulate borrowing and economic activity. This encourages investment and spending, but low rates for too long can cause excessive borrowing and inflation. Inflation, a sustained increase in prices, erodes purchasing power. The Federal Reserve fights this by influencing interest rates. Raising rates can slow inflation, but risk stifling growth can cause job losses. Balancing inflation control and economic growth is the Fed's challenge. Employment is one of the most important indicators of economic wealth and health. When more people have jobs, consumer spending rises, fueling economic growth. But how does the Federal Reserve influence employment? The Fed uses monetary policy to guide the economy. For instance, lowering interest rates makes borrowing cheaper, encouraging business to invest, expand, and hire. At the same time, lower rates make it easier for consumers to buy homes, cars, and other goods, further boosting demand and creating more jobs. On the other hand, when the Fed raises rates, borrowing becomes more expensive. This can slow down economic activity, reducing demand and potentially slowing job growth, or even causing job losses. The Federal Reserve's ultimate goal is to strike a balance, fostering sustainable economic growth while maintaining a healthy, stable job market.
The U.S. economy is a vast and complex machine. At the heart of this intricate system lies the Federal Reserve, often referred to as the Fed. Like a vigilant guardian, the Fed watches over the U.S. financial system. It plays a crucial role in shaping the economic landscape of the nation. Think of the Fed as like conductor of an orchestra. Each instrument represents a different aspect of the economy. The conductor ensures that all parts work in harmony. The Fed's importance cannot be overstated. Its decisions have far-reaching consequences for businesses, consumers, and the overall health of the nation's economy. Understanding the Fed is paramount to grasping how the U.S. economy functions. The year 1907 witnessed a severe financial panic that shook the nation, known as Panic of 1907. Also, or the 1907 Bankers' Panic or Knickerbocker Crisis, whatever. Panic spread like wildfire as depositors rushed to withdraw their savings. The financial system teetered on the brink of collapse. In the absence of a central bank, the responsibility of averting disaster fell upon J.P. Morgan. This legendary financier orchestrated a private bailout, using his personal fortune and influence to stabilize the markets. The crisis exposed the fragility of the existing system and underscored the urgent need for reform. The Panic of 1907 served as a wake-up call. Congress recognized the need for a permanent solution to the nation's recurring financial woes. The Commission's findings paved the way for the creation of the Federal Reserve System. In 1913, after years of debate, Congress passed the Federal Reserve Act. This landmark legislation established the Federal Reserve System, a central banking system designed to provide stability and flexibility to the nation's financial system. President Woodrow Wilson signed the act into law, ushering in a new era in U.S. monetary policy. The Federal Reserve Act aimed to address the shortcomings of the previous system. It created a decentralized central bank with a network of regional banks spread across the country. This structure ensured that the Fed would be responsive to the diverse economic needs of different regions. The act also established the Federal Reserve Board of Governors, a group of officials appointed by the President and confirmed by the Senate. The Board of Governors was tasked with overseeing the Federal Reserve System and setting monetary policy. The creation of the Fed marked a significant shift in U.S. economic history. Since its inception in 1913, the Federal Reserve has played a pivotal role in shaping the U.S. economy. It has weathered numerous economic storms, from the Great Depression to the global financial crisis of 2008. The Fed's actions have helped to mitigate crises and promote economic stability. The Fed's history is not without its critics. Some argue that the Fed's policies have at times exacerbated economic problems. Others contend that the Fed has too much power and operates with too little transparency. Despite these criticisms, the Fed remains a cornerstone of the U.S. financial system. Today, the Federal Reserve continues to adapt to the ever-changing global economy. It faces new challenges such as the rise of cryptocurrencies and the increasing interconnectedness of global financial markets. As the guardian of the U.S. economy, the Fed's role remains as vital as ever. The Federal Reserve is not a monolithic entity housed within a single imposing building. Instead, it's a carefully designed network, a symphony of interconnected parts working in unison. This decentralized structure ensures that the Fed remains attuned to the diverse economic landscape of the United States. At the heart of this network lies the Board of Governors, a group of 7 individuals appointed by the President and confirmed by the Senate. Beyond the Board of Governors, the Federal Reserve System encompasses 12 regional Federal Reserve banks, each responsible for a specific geographic district. Imagine the Board of Governors as the captain and navigators of a grand ship sailing the seas of the U.S. economy. They chart the course, setting the overall direction for monetary policy and financial regulation. Their decisions have a profound impact on the nation's economic well-being. The Board of Governors meets regularly to assess economic conditions and make decisions about monetary policy. They analyze a wide range of data, from inflation rates to employment figures, to gauge the health of the economy and identify potential risks. Their oversight helps prevent crises and maintain public confidence. Within the Federal Reserve System, the Federal Open Market Committee, or FOMC, stands as a pivotal decision-making body. Comprised of the 7 governors and 5 presidents of the regional Federal Reserve banks, generally the FOMC convenes 8 times a year to deliberate on the course of monetary policy. The FOMC's primary tool for influencing the economy is the federal funds rate, the interest rate at which banks lend reserves to each other overnight. By adjusting this rate, the FOMC can influence borrowing costs for businesses and consumers, thereby affecting economic activity. Their goal is to strike a delicate balance, promoting economic growth while keeping inflation in check. The 12 regional Federal Reserve banks serve as the Fed's boots on the ground, providing essential connections to local businesses and communities. Each reserve bank operates independently within its district, gathering economic data, providing financial services to banks, and serving as a liaison between the Fed and the public. These regional banks play a crucial role in the Fed's payment system, facilitating the trillions of dollars that flow through the economy each day. They process checks, transfer funds electronically, and provide banks with access to currency and coin. Beyond their operational responsibilities, regional reserve banks conduct economic research and analysis, providing valuable insights into the unique economic conditions of their districts. They publish reports, host conferences, and engage with local businesses and community leaders, fostering a deeper understanding of the Fed's role in the economy. Imagine the economy as a vast orchestra, with countless instruments playing together. The Federal Reserve, in its role as the maestro of monetary policy, conducts this orchestra, guiding the tempo and rhythm of economic activity. It does this through a range of tools and strategies designed to influence the flow of money and credit. At the heart of the Fed's monetary policy toolkit lies the federal funds rate, the interest rate at which banks lend reserves to each other overnight. These operations, conducted through the Federal Reserve Bank of New York, have a direct impact on the availability of credit. The Fed's monetary policy decisions are guided by a dual mandate from Congress to promote maximum employment and stable prices. The Fed aims to keep inflation in check, targeting a rate of around 2% per year, which is considered healthy for a growing economy. However, the Fed also recognizes the importance of economic growth, which creates jobs, boosts incomes, and improves living standards. While the Fed's monetary policy and regulatory roles are widely recognized, it also performs a range of essential but often overlooked financial services that keep the nation's payment system running smoothly. These services, though largely invisible to the public, are crucial for the functioning of the economy. One of the Fed's key services is providing banks with access to currency and coin. When banks need more cash to meet customer demand, they can order it from the Fed, which distributes currency and coin through its network of regional banks. The Fed also plays a vital role in clearing checks and electronic payments, acting as an intermediary between banks to facilitate the transfer of trillions of dollars each day. This clearinghouse function ensures that payments are processed quickly and efficiently, reducing risk and promoting confidence in the financial system. Navigating uncharted waters. The 2008 financial crisis. The year 2008 witnessed a financial earthquake that shook the global economy to its core. The collapse of Lehman Brothers triggered a cascade of failures throughout the financial system. When the housing bubble burst, defaults surged, triggering a chain reaction. Banks stopped lending. The Federal Reserve faced a crisis of unprecedented scale. Traditional monetary policy seemed insufficient to restore confidence. Bold and unconventional actions were needed to avert a complete meltdown. The Fed's response to the crisis. The Federal Reserve deployed extraordinary measures, acting as a lifeline in a raging storm. The Fed extended emergency loans to a wider range of institutions, including investment banks. To inject liquidity, the Fed launched lending facilities, providing short-term loans against various collateral. These facilities helped thaw the frozen credit markets, enabling banks to resume lending. The Fed also embarked on quantitative easing, purchasing long-term assets to stimulate economic growth.
Don't forget to like, comment, and subscribe.